Hello and welcome to the lecture for part 2 of chapter 4. So in this section of the lecture, I'm going to talk about a few more inventory related issues, and then I will speak about income statements in greater detail, about gains and losses, and then income statements in greater detail. So to start off with, I want to discuss inventory shrinkage. What that term means is that we may have perpetual records, remember, where we keep track of every single item in inventory. We add to it as we make purchases, we subtract as we make sales, so we have a running theoretical balance of what everything is in our warehouse. And then at the end of the year, we're required, regardless of whether we use periodic or perpetual inventory, we're required to do an inventory count at year end. And as is often the case, we end up with less items actually on hand than what our perpetual records would indicate. The reason for this might be that somebody made an error when they received or shipped something. Things may have become broken or damaged and thrown away, and the inventory records weren't updated. Or unfortunately, there could be theft. Items could have been taken by employees or by customers potentially. So those are all reasons that we could end up with less inventory than what we thought we had. And also, I would say many well-run companies don't wait to year end to take account. They do what are called cycle counts. So maybe every week or every couple of weeks, they're out counting items and comparing them to their perpetual records and making adjustments throughout the year so they don't have one big adjustment at year end. Regardless, when the physical count is done and there's an adjustment to be made, we'll record it as I show here, where we reduce inventory by the value of the items that are no longer there, and we recognize an expense for that under retained earnings. Well, either if it's a small amount like what is shown here, we'll just include that in cost of goods sold. If it's unusual, like say there was a loss of inventory due to a fire or something or a flood, then we might call that an other kind of expense. So we pull it out of cost of goods sold, or we don't put it there to begin with, and we record it as an expense like that to draw attention to it. So the other thing I want to talk about are sales returns, allowances, and discounts. So we talked about this a little bit when we talked about inventory from a buyer's perspective, but now I want to talk about it as a seller, okay? So in this case here, anything that we sold could arrive damaged, or we may have shipped the incorrect item, and so we'll make an offer to the customer of either one of two resolutions. Either we take the inventory back and give them a refund or a credit, or we give them an allowance, so a reduction in the price. So in the case of a return, we're going to reduce our sales and accounts receivable, and then we're going to increase our inventory and decrease our cost of goods sold. And I'll show you that in a grid in a minute. In the case of an allowance, we're just going to reduce sales and accounts receivable. We leave inventory and cost of goods sold alone because nothing is coming back to us. So think about the inventory that's coming back to us. If it's the incorrect item, well, we can put that back on the shelf and sell it to somebody else, so our inventory increases. So in the case here, in the first transaction, we sell a portion of the inventory for $8,000 on account. So accounts receivable goes up, retained earnings goes up. We recognize the cost of goods sold. In this case, it's 50% or $4,000. We reduce inventory, and I've got an error there. That $4,000 under retained earnings should be a negative number. I apologize for that. And then we accept the return of goods that have a value to what we charge the customer of $600, but a cost of $300. So we reduce accounts receivable and reduce retained earnings for that negative impact of reducing our sales and what the customer owes us. And then we put $300 worth of inventory back on the shelf. So we increase our asset and we decrease our cost of goods sold expense with a positive number there under retained earnings. Now the scenario below that is where we just offer an allowance. So we just offer a price break to the customer as a way of an apology. So in that case, we record the sale the same, and I have the same error there of it should be negative $4,000 under retained earnings. And then we just reduce our receivables and reduce our retained earnings because we're lowering our sales figure. So the other thing, as we mentioned, when we were a purchaser, sometimes we are offered cash discount terms that we could take advantage of. Well, the same thing is the case with a seller. The seller will offer cash discount terms in the hope that people will pay more quickly. And again, that format you may remember is 2/10 net/30. That means a customer can take a 2% discount. That's the first number. If the payment's made within 10 days, that's the second number. Otherwise, they have to pay the full amount in 30 days. So that discount reduces the accounts receivable and reduces the sale. So the way that looks here is we record a sale of $10,000, so accounts receivable and retained earnings. We recognize the discount that we've offered, so negative $200 on receivables. The customer, we believe we're actually going to get $9,800, and we reduce our sales by that amount. And we recognize cost of goods sold. And again, I have perpetuated that error of the $4,000 under retained earnings. You can tell I copy and pasted that. Sorry about that. And then when I receive the payment within 10 days, I increase cash and I reduce accounts receivable. Another error there. Sorry about that. Okay, the other thing I want to talk about are gains and losses. So when we sell a long-term asset, if we sell it for more than the book value, we're going to recognize a gain. If we sell it for less than the book value, we're going to recognize a loss. And that is important in terms of how we portray that information on our income statement. Now, of course, it's going to be a component of our overall net income, that gain or loss. But think about that gain or loss in selling an asset is really something aside from our normal purpose of being in business. Say we operate a restaurant. So the main purpose of our business is to prepare food and sell it to people, right? So if we decide to sell an extra freezer that we have that we're not using, and we make a gain on that, that really doesn't have anything to do with making food and selling it to people. It's aside from that, right? So we're going to record that after a new line on our income statement called operating income. So we want to be able to explain to somebody, here's how the core operations of our company did, what we're in business for, and then here are the other items that also happened and what our end result was. So I'll take a look at that on an income statement here that's a bit expanded. So remember, whenever we sell goods, as opposed to providing services only, we're going to have sales revenue minus cost of goods sold. That's going to give us gross profit. That's what's left over after we sell the products that we purchased and resold to customers. Then I'm going to have less operating expenses. So I'll have selling and administrative expense, and in this case, they have transportation out. So they've apparently made some sales to customers on an FOB destination basis and recorded that expense. So now that's the core purpose of their business for this plant shop. So their operating income was $7,300. Okay, so they had a positive result from their operations. Now they had some non-operating items. So they had some items that were outside the normal course of their business, one of which is interest expense. So interest expense and interest revenue are always going to be part of those non-operating items, because unless we're a bank, that's not the business we're in, isn't borrowing or lending money. Then we're going to recognize the gain on the sale of land. This company had a $700 gain on selling land. Again, they're not in the business of buying and selling land, so that's a non-operating item. And then that gives us the bottom line net income. So that's the end of Chapter 4. If you have any questions, please send me an email, and thank you for listening.